Eddie, this whole, you invest in all these verticals. So maybe by way of, maybe you kick it off, this introduce Virtue Capital and how you're set up. And you also do it a little differently because you're investing in Don's fund. You're investing in Julia's fund. So you're a fund investor as well as directs. Go right ahead.
Yes, essentially take every fifth person of the room and I give them some money to play with. It's a very simple model.
Well, it's a special room though, right?
Spray and pray.
I like to think.
No, so Virtue Capital Fund, we started, Rich, Sobel, the better looking half, and me, started earlier this year, is an impact venture fund that aims to invest in 5 verticals. And AgTech is one of them, health tech is one of them, education tech is one of them. We invest small. We invested a ticket in Don's fund, who just saw, who was in education. Cannabis is one of them, and climate change is one of them. So I think we've hit all of them over the last couple of days. That's why you see me sometimes too often. It's not my fault, it's Mark's fault. We aim to invest in late seed stage through Series B. So we do want a demonstrated product market fit for our companies to take sort of some of the risk out of there and retain some of the upside. We started a little earlier than Series A typically because we see a lot of value creation early on. And each different vertical has a different subset of benefits that inure to society. We want a double bottom line approach, so not concessionary on returns, but in climate change, that's CO2 reduction. And in healthcare, there can be many things, but probably patient outcomes and better access is one of them. And we look for very strong managers, leaders, visionaries, strong teams, and a tech differentiable edge that can scale relatively easily with increasing returns. And we invest tickets between sort of $1 million and $3 million. So that's sort of more or less the fund in a nutshell. We do have a capacity to invest in managers that have extraordinary access to early stage deals. So Don Burton, for example, in LearnStart, Julia Monfrini in Pace Capital, that can provide us with excellent vetting capabilities and excellent deal flow access, because we can't possibly be credible deep domain expert in five sectors, even though we wear appropriate clothing for that. And that's all. I'll leave it at that and have John take it away.
Thanks, Eddie. I apologize if any of this is repetitive from yesterday. My name's John Coppolino. I'm one of the founders of Tigress, a solutions-oriented specialty chemical company. And our companies, we're very blessed, and we have a very simple model. We manufacture a safer acid, which would be a low pH acid, and a safer alkaline, which would be a high pH, 13 or 14. And our business model is to look to replace hazardous chemicals with a safer alternative by licensing that technology to leading brands and leading companies in specific industries to help them become more sustainable. And if we've been paying attention for the last 48 hours, impact and sustainability is a big focus, not only of this conference, but of every company in America and around the world. If you go to their website, you'll see a little tab that says sustainability. Now, you do have to be careful because everyone defines it differently. So you have to look at what that company's definition is of sustainability. But what we bring to the table is the ability to, in many cases, eliminate a hazardous chemical. So yesterday we talked a little bit about cleaning. Today we're more focused on ag tech and food tech. And we have really interesting applications in both that also have significant impact. One is our product can work as a wash. So I grew up in the food industry 20 years. I've been in hundreds of plants. And when raw materials come into the back end of a food manufacturing facility, they have to be cleaned and disinfected. Typically, they use a Clorox bath or some type of bleach to clean the celery or the potatoes or whatever that raw material is that could have bacteria on it. We can replace that with a more sustainable solution, and most importantly, we can extend the life of the product. So when you think of the impact, You know, one of the companies we've had some initial conversations with is the Food Corporation of India. They're the largest distributor of food, of grains and fruits and vegetables in the world to the poorest people in India. And the premise is if we can extend the life of the product a day or 2 days or 3 days, more people get fed. And that's as basic as it gets. Now, from the other side, we're working with a company called Eagle Eye, which is a large potato grower, and they were looking to extend the shelf life of a fresh cut potato so that they could distribute it across the country because it only had about a 15 to 20 day shelf life. Through about 6 months of testing, we were able to extend their shelf life to 40 days, and now they have the first fresh cut French fry that'll be distributed in 63 U.S. foods distribution centers under a private label, which is very unusual for U.S. Foods or Cisco to just blast out a private label and force distribution. But you got to think about the French fry industry, frozen is billions of dollars. So if you can change from frozen to refrigerated, the impact in the environment is significant because, number one, you're going to lower your cost of transportation. You're going to lower your cost of storage. And then you're going to lower your energy cost. And what does that do when you lower energy cost? Lowers carbon footprint. Yeah, you're lowering carbon footprint. And by the way, the French fry tastes better. Can't lose that. So we've done it in potatoes. We've now tested apples, green romaine lettuce. Oh, everybody's gone into a supermarket and bought that chopped up lettuce, and you have to look at the bottom to make sure it's not brown. So there's applications all through the food side of extending shelf life, which is really exciting for us. Second, on the crop side, we just finished completing testing on about 30,000 acres. I think it was 15,000 of just soybeans 2 years ago. And we saw a 13% yield increase, crop increase in soybeans, working directly with the farmers, mostly in Michigan, with some of the top farmers in Michigan. So they're getting a 5-to-1 on their return. If they give me $100, they're making $500. And all they're doing is they're adding our soil amendment, which is acid-based, to whatever they're using to get whatever they need to get on the crops, whether it's the pesticide or fertilizers. And what our product does is it maximizes the nutrients in the soil, and it just helps the plant grow healthier and bigger. And we've done 13 crops in probably 7 states. We went direct first to prove concept, and now we're signing up distributors, but we're also looking for global partners around the world because this has significant impact on the AgTech space. And our business model is to license our technology. So we're kind of a lean and mean business model. We don't need to go get 140 salespeople. We license our technology to the second largest cleaning company in the food industry called AFCO, and they compete with Ecolab's cleaning food plants. Conagra's their biggest customer. They have the 140 salespeople. So we just need to help them reformulate their products so that they can then take it to their sales force. So that's kind of on the food and beverage side.
All right, this is on. It is. So we're going to make this a little more interactive than just me talking to you. So by show of hands for everyone in the room, who is invested in real estate? Commercial, multifamily, whatever it is. Okay, great. How many of you have ventured in venture capital? How many of you invested in private equity? How many of you were invested in crypto? How many of you were invested in a consumer brand? That's pretty good, actually. That's an index higher. How many of you invested in a consumer brand through credit? Well, you cheating, because you're with me. So how many? Like 2? Okay. So what we effectively do at BFY is a strategy that our family launched is specialty credit for consumer brands, specifically within food, beverage, beauty, and pet. And the reason why we did that was a couple of reasons. As you finance these companies, they're capital intensive. These are brands that we want to share with our friends, our families, depending upon how good you are with a friend or not. But these are things that are in our lives every day, right? Everyone eats, we all kind of shower, hopefully some more than others. But effectively, there's been a big trend. I think, one of the speakers earlier talked about this triple upshift, right? This kind of notion of alignment of values, alignment of sustainability, alignment of a conscientious consumer who's making decisions, purchase decisions based upon an affinity for what's better for them from a health and wellness perspective, what's better for the environment, and what's better for society from a fair and equitable standpoint. And brands that adhere to that typically show a much stronger brand affinity and relationship and performance, right? The problem is building a brand is really expensive, right? And unfortunately, the capital solutions that are available to them are bifurcated, either between equity financing, which most of us are exposed to, or lines of credit to support inventory and receivables, right? Either through factoring or lines of credit. No one has really kind of doubled or tripled down on this idea of providing these companies with venture debt, which you would normally see across Silicon Valley Bank and Square One and WTI and Comerica and Triple Point for more established middle market players, one, or two, investing really where the sponsor is with Andreessen or Excel or someone else, right, as the sponsor backing it. And we kind of ran the numbers from an impact standpoint for our family. We were looking for a way that we could touch everyone's lives for the products that we invested in. That you would walk down a Whole Foods or a King Cullen or a Publix or H-E-B, wherever you were in the country, and have an impact by consuming those brands that we back, number one. So there was an immediate affinity. Number two, we were making sure that the founders who spent years building these brands were not getting killed on the cap table. This is a long cycle. If you're in the equity, this is like a 15-year journey to build something of substance, unless you can really kind of catch lightning in a bottle. So you spend all this time and effort building this incredible product that hundreds of thousands and millions of people enjoy, and if you're fortunate enough to get an exit, you get virtually nothing in return, either as the founder, because you're layered by the preference stack, or as the early investor, friends and family, because you're layered by the preference stack. Right? So you're absolutely screwed for the risk that you take. So we said, that kind of sucks, right? Why should I be in a situation of being in a brand, but I get no return, outside of just feeling good about creating something that people enjoy? So what we set out to do was kind of reset the table and say, look, founders, passionate people that are introducing these great brands for us that we consume every day should have a greater share of the upside. That's number one. The second part is, if you're an investor in these companies in the equity, you're getting absolutely slaughtered, right? It's a 15-year cycle typically. If you're investing in debt, we typically have a 4-year term, you can basically turn over our capital 3 times, fund 3 separate businesses, which is much more advantaged, right? And the last part was, it gave us something that was tangible to share with our families, right? So I've got 3 kids. I've got an 11-year-old, an 8-year-old, and a soon-to-be 6-year-old. I can't explain like Internet of Things technology or cryptography to them or blockchain, but I can share with them a gluten-free cookie, right? And tell the founder journey about how they had maybe celiac disease or they had some other type of autoimmune deficiency that they were trying to address through food, because we're very big believers that food is medicine, right? It's a way to kind of offset diabetes and heart disease and all these things. These are simple habits that we can have a part of everyone's lives every day, but also too, we can be evangelical about them, right? So, I kind of go back to this premise of you don't always have to play by the same rules. Sometimes you have to invent them, right? So we got kind of sick and tired as a family office looking at the same types of investment strategies from the same managers and the same private equity firms for the wirehouses that our family's a part of. And through our own family office, we said, look, we can have an impact. We can get a great kind of risk-adjusted return. We can interact with these products every single day. And on top of it, right, we've effectively run kind of a syndication strategy for years. We get to work with other families that really kind of value the types of brands that we're backing in a really thoughtful and constructive way, right? So for us and for what you're doing, the impact orientation is how can I affect as many people as possible, right? That's not going to have a 10, 15, 20-year kind of life cycle that I have to see the fruits of my labor. I can see it in the spins and IRI and data reports that I get every couple of weeks about how our brands perform. As they expand their distribution, they expand their velocity, I can see how much they're promoting their sales or not. So it becomes an asset class that most people don't have a lot of exposure to, but ironically, we consume these products every single day. So anyway, that's what we've been doing at BFY Capital on behalf of our family. We've been running Working Lab Capital for the better part of 7 years, investing opportunistically, and this is a strategy that we're spending the majority of our time on. So anyway.
I'd like to chime in here. Rich, you're almost underselling yourself. Rich is when I invested a small check in one of his strategies, like the Billy Bean of the food sector. Right? He has an unfair advantage through all the spins and IRI data, and he underwrites stuff based on much more sophisticated metrics than banks can do on the debt side, and much smarter than equity players can do on the equity side. So that was the sort of the one paragraph sale, and I said, well, that makes sense. And then I showed it with the one asset we were looking at. It makes a lot of sense to do it if you do it and go deep in it. I like when investing in private debt, you really want to be part of somebody who just owns a vertical and has a sort of an unfair advantage based on the data they collect and the wisdom they garnered over time and the mistakes they make over time. Obviously, you do that too. You learn from that, and that's what Rich for me is.
I love that unfair advantages, the edges and all that. That's what we're all establishing. So if you know other managers with an unfair advantage or an edge, bring them into the flock. Is the food and beverage impact? And you've got something really interesting, and I wouldn't let you walk out the door until and you might have to show it to everybody. So, of the five verticals, there's one that's not here, which is cannabis. But here's an impact.
Unfair disadvantage, I think.
So is it really good to smoke and vape cannabis when you could do something like this?
Appreciate the question. Pleasure to be with everyone today. I'm fresh in from California, where beginning this year we launched Alt. And tell you a bit about Alt. Alt is an alternative to smoking. It is an alternative to drinking alcohol. It is really an alternative way of consuming, and we stand for an alternative lifestyle. These products that we've initially introduced in the California market are 5 and 10 milligram beverage enhancers that are backed by a proprietary nanotechnology. To break that down simply, we break down the particle size of cannabis into nanoparticles. That allows for much greater bioavailability of the plant. It allows for a 5 to 15 minute onset. The medicine bypasses the blood-brain barrier, the liver, creating those immediate effects. It allows for a very controlled experience and a very controlled 2 to 3 hour offset. And so with Alt and these initial SKUs, we're really empowering the consumer to create their own cannabis experience, to decide exactly how many milligrams they want, to put it into their beverage of choice, and to build their euphoria until they find that sweet spot. With the tech, we're able to wholesale white label, to move into creating beverages for other companies, creating edible products. We can do topicals as well. And the power really is in the technology with respect to efficacy and with respect to consistency of effects. We're live in California. We are moving into the UK and Germany with Grow Pharma, a deal that Anand, who probably most of you know, orchestrated. And we're looking at another very interesting international play in Israel. And so just getting started, but we certainly believe that a cannabis beverage is the future of the space. That's going to be the biggest category. The why, beverage, food, it's how we most consistently connect across all cultures. And it's a very small category at this point in time, but as the new and emerging consumer rises, we see them gravitating heavily towards ingestibles. And you can't really have a social experience with a gummy, but you certainly can with cannabis beverage. And so that's why we deliver these products, and that's where we expect the market to go in the years ahead. Thank you.
All right, so this is the Ag Food and Beverage. Any questions for what you've heard so far? All super clear? You're nodding your head up and down. Any questions whatsoever? Oh, Sam, yell until I get there.
So on the alt beverage, I've tried it. I think the impact is outstanding. The flavoring seems to be just, there's a lot of flavor to it. Have you thought about making it like a little bit, either more neutral to like a non-flavor, or like other options on the flavoring? And there's a group called Cannabistry Labs in Chicago that does flavorings for beverages, if you'd want an introduction.
Can someone give? Yeah, thanks.
Yeah, so with this particular formulation, we have designed it to be as neutral in flavor as possible. There are some bitter blockers, there's some natural sweeteners, and we did want this to be flavor neutral so that it can adapt to most beverages. Certainly, there's flavor profiles that it combines better with. So as an example, juices, anything with citrus, it's going to combine very well with. Beer, which we can't promote, alcoholic drinks, which we don't promote, coffee, flavored sparkling waters. And so one of our biggest challenges is, given the form factor, the 5 ml form factor, you don't have a lot of real estate to work with flavoring. And so one thing I like to help people understand is that in the cannabis beverages and market, they're designed, the entire beverage, 6, 8, 12 ounces around this. And so the idea of this, again, is to create your own beverage. We are moving these products to live material, so live resin, live rosin. And what that allows for is naturally a more neutral finished product before masking and before flavor work. It also brings forward a lot of the terpene profiles. And so our next wave of products will naturally be more neutral, and then with the flavor work, be even more so. So we've certainly taken note to that. It's not recommended there.
All right, you guys
just
can get a
something like-
room on this flavoring thing. What other questions do we have? Any other questions? By the way, I'm just, as anecdotal, this is very popular with wives. Just, I happen to know that. Your product, that is. Other questions? Well, to me, this is the most. Oh, go ahead.
So for debt investments, what's your criteria? For debt investments, so what's your criteria? What stage companies need to be?
Typically, it's
Thanks.
capital. They have anywhere from, call it, 15 up to 50 million in revenue, where equity is still really expensive. They can't get access to structured credit, and debt financing is really just still limited to ABLs. So that's kind of the inflection point where we think there's good enterprise value for us to make the loan. We have a good amount of security and cushion. We're a secured lender. These are not unsecured loans, and they can also afford the debt service, right? So there's a good kind of trade-off between the way that we structure, where you have to be a larger size company, and then per Eddie's point earlier, I mean, we're a bunch of data wonks. So we did a proprietary study with Spins and IRI, which is a point of sale data aggregator, and you basically find that brands that are below 5 million, we call it the valley of death, right? So they have a high failure rate. So we typically invest in companies at a minimum of like 7.5 to 10 million as the earliest stage, with a more aggressive type of secured product that we have. And then for companies that are later stage, we can typically do like bridge to exit financings, et cetera. So I would say anywhere, it's a wide swath, which is what we like, because it gives a lot of different companies to finance based upon their circumstances. Well, Mark's not here anymore, so any other questions for anyone else up here? There's Mark.
All right, you have $1 million. Deals closed. It's like 5 deals. It's closing tonight. Where are you investing?
It can't be our own stuff.
Yeah.
I mean, I'll be selfish. I mean, we're doing this as a family. We put several $1 million to work in our own strategy, so I would continue to plow money back into what we're doing. So we're continually building a fintech company called BFY Capital. We've been financing it on our own balance sheet and in syndication with a couple other families. So I continue to kind of bet on myself and the team that we put together.
fast tracking new SKUs in California, scale in California, fast tracking UK and Germany opportunities in addition to Israel.
Don't say you're going to put it to Virtu Capital.
Not. Obviously, I will. We're really looking into a circular economy as part of the solution to a lot of AgTech problems. So, for example, we're looking right now at a recovered carbon black play. Obviously, a massive issue with tires and reusing of tires. And nobody has yet broken through. We believe we have a company that has solved the formula, at least to a certain extent. While everybody has pledged, almost like the COP26 pledge, all the Pirellis of this world have pledged by 2050 to have a substantial amount of their tires be from recovered carbon black. And so we think that's going to be a massive industry, and to the extent we found a solution, I would invest everything in that.
So that's the next co-invest we're going to look at? Yep. Yeah, cool. You have 5 verticals. Maybe which vertical you're excited about?
I'm going to invest in the venture debt over on the right. I'm investing in venture debt. So, AgTech and food tech, for anyone who's invested in those sectors, they're super hot right now, especially food tech. So I would always look at the food tech space right now to see what's the new innovation that's going to drive the next wave of where food tech's going. And whether it's our company or another company in the food tech space, if you can see where they're bringing a value proposition that makes sense and the margins are right, you can have a good long-term strategy. So I love both of the spaces.
You're going to stick around for the breakouts?
I got to do a presentation.
And then you're going to come back and
Yeah,
play ping pong?
I'll be back. Yeah, I'll be back.
Some more closing comments. Like a lot of technologies in ag, and I think John has mentioned a lot of it. That there's been a tremendous underinvestment in ag over the last decades, actually since inception. It's the largest $7 trillion marketplace, and so right now it's all trying to catch up. So ag VC bankable, investable assets have doubled over the last 5 years and going to double again over the next 5 years. And it's necessary. So, for example, if you look at the soil, right now 90% of the lettuce is grown in Arizona and California. That will stop to exist. A large part of that market will simply not be there over the next 30 years because it becomes unarable land. Soil will deplete, climate disruptions will take place. And so outdoor ag will have to be replaced with an alternative, indoor ag. And so it's exciting to work on sort of things that we take for granted as buying lettuce on the shelf, that will be produced in a completely novel manner, hopefully more cost efficient, hopefully with less waste, hopefully with less energy used. I think that's extremely excited to work on those type of systems, where as a consumer you might not notice and might not care, but it's important.
We got to move on to health. And what's great is when you grow up, and when these babies grow up, they can accelerate with non-dilutive capital from our friend over there, Rich. And you're sort of you're getting grown up too. So that's what I love when our community can interconnect like that. Just full disclosure, if they're not, they're sort of our clients. A lot of people in this room are clients. So, but we've done diligence on them. We're excited about them. So, awesome, beautiful. Now, thank you.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.